Hello, welcome to Strictly Money at the News Forum, where all voices matter. I'm your host, Saijal Patel. In case you missed it, Loblaw, Canada's largest food retailer, recently announced it's ending its no-name product price freeze. And this comes at a time when experts are warning that even higher food prices are on the way. Well, my next guest has some advice on how to save on your grocery bill and which credit cards will give you the greatest bang for your buck. Natasha Macmillan is Director of Everyday Banking at Ratehub.ca, and she joins me now. Hi, Natasha. Great to have you on.
Hi there. Thanks for having me.
So, there's been a lot of criticism towards Loblaw, right? Some are claiming that this was just all a publicity stunt. But I say whether it is or not, whether it was or not, the fact is everyday Canadians are struggling to put food on the table. Do you have any sense, Natasha, of just how much prices have gone up in the past year?
Absolutely. We've seen some studies come out saying that we can expect families to spend upwards of $1,000 more on food in 2023. So the average increase of inflation for vegetables, for example, is anticipating to go up 7% in 2023, which will start to hit families pretty soon.
So that was my other question, Natasha. Is this across the board that you're seeing, say, fresh produce prices rise faster than, say, packaged items?
Absolutely. We're seeing increases across the board. Some, of course, have higher increases than others. So, vegetables being one of the highest. And then we've also seen a lot of news coverage on the dairy increases as well that we're expecting to come shortly.
What's driving it? And do we have any sort of sense of whether there's relief on the way?
So, some of the factors that we've been hearing that have been driving it are kind of the climate change, geopolitical conflicts, and potentially some of the lingering effects of COVID. And then, of course, the transportation. And then, particularly in the dairy field, they're saying a lot of it is the rising cost to run the operations. And when we look at the transportation side and location, sometimes in rural locations, there aren't as many stores and it does require further transportation. So those costs are increasing.
Okay. So, lots of people have tried to find ways to cut back on their grocery bill. I'm seeing, they're eating less meat. They're buying things only on sale, for example. What else can they do?
My biggest tip would be to create a grocery list. And part of that is starting by setting out a meal plan, whether it's for a week to 2 weeks, out kind of creating what that list will look like. And from there, creating your grocery list. That will help you ensure that you're not overspending or getting caught into the store if you see a discount and a sale and you kind of drive towards it. This has shown that it can actually save you 20% over time on your grocery bill, which in today's kind of rising cost of groceries can have a big impact. The other tip that we would look at is to actually track your grocery spending. So that will help you understand how much you're actually spending. And I know at the beginning of the year, people kind of look to setting that out. If you actually start to lose track of that, then you'll start to not realize that monthly impact to your budget. And so it's important to kind of keep that top of mind. And my last tip that I've started to personally see more and more when going grocery shopping is price matching. A
Hmm.
lot of grocery stores offer the capability to shop around through flyers and use coupons and price matching. And that can drive huge savings at the end of the day for your grocery bill.
Yeah, it's certainly one that I do, and it's funny about the list as well because I have to do that because I'm someone who goes into Costco and it's guaranteed I'm going to leave there with one or two items that were not on my list. But also the coupon and the price matching. I personally, I don't know if this is available across Canada, but I use Flip, which is
Yes.
fantastic. And I take the photos, and I'm very organized, and I found that I've saved lots of money.
Absolutely. And especially as the family gets bigger and things like that, those savings can actually really have an impact on families. And again, try not to go grocery shopping with others. It's best to go alone. I try to make sure I leave my kids at home because they could easily distract you to add a few things to that shopping cart. And even shopping on an empty stomach. we get a little excited and we're hungry, so we throw a few extra things in the cart. For me, it ends up being chips or something I probably don't need anyways, but
Yeah. All right. We're going to take a quick break. Those are great tips. When we come back, we'll talk about the credit cards. Welcome back, Natasha. Let's go through some of the credit cards that people can use that might help them save on their grocery bills, and we have a board, so we'll go through some of these.
so one of the key things to keep in mind when going grocery shopping is identifying what card will benefit you the most for that spending category. So there are a lot of credit cards out there that actually offer a higher percent cash back or point reward point earn rate for groceries. So one of the ones that we highly recommend if you shop at Freshco, Loblaws, and Superstore is the Scotia Momentum Visa Infinite. The annual fee for the first year is waived, but it does earn you 4% cash back on your groceries. And that's a very high earn rate. And so that's another great way to kind of save you money over time on your grocery shopping.
Okay, so look for things like pay attention to the annual fees, but the cashback as well. We'll pull up the
Absolutely.
board again. What else? There's a few other ones. Costco. I know a lot of people shop at Costco.
Yes, Costco is one that you will probably hear has more difficulty in accepting credit cards. One that we recommend there is the MBNA Rewards World Elite MasterCard. So that is readily accepted at all Costco's. It does carry an annual fee, unfortunately, but has a high earn rate of 5 points for every dollar at grocery stores, particularly at Costco. And so that does allow you to kind of earn those points there. And another card we would recommend is the Rogers World Elite MasterCard. There is an annual fee with that as well, which is waived for the first year. And you do earn points for that.
Okay. At the bottom, we did have the website where they can go and check out more of the details. Back to the annual fees, right? There's some that actually it can be quite high. Is there a type of consumer that it would be more suited for, and ones that wouldn't make sense?
Yes. So typically, what we recommend is if you are someone who actively pays off their credit card bill every month and you're looking to earn those rewards, it can be worthwhile to have a credit card with an annual fee. However, the moment that you might miss a payment or might not pay the full credit card bill monthly, you start to lose the benefits of the rewards programs that you get by paying an annual fee. So, if there is any doubt on whether you might be able to kind of pay that full credit card bill, we do recommend that users look to low interest credit cards or no annual fee credit cards.
Yeah, that makes a lot of sense, Natasha. What are the pros and cons to, say, collecting points versus cash back?
So it really depends if you're loyal to one particular retailer. So an example that I can give is with my family is we shop at the superstore up the street. And so while we use kind of the right credit card to benefit from the cash back, we also double up and stack with our PC Optimums point. And that kind of allows you to kind of get both benefits from it. And over time, you could use those points to actually pay off your full credit card bill or whether you're going, not your bill, sorry, your grocery bill. And then you could also use it to kind of pay for some shopping that you do at Shoppers Drug Mart. So it does kind of give you that extra benefit. However, with the store piece points, it only allows you to accrue points at that particular retailer. So it is a little bit more constrictive than a cashback credit card.
Yeah, and I was going to ask as well, loyalty cards, right? Because a lot of the grocery stores have them. Is
Yes.
there a way to save on loyalty cards? A little bit different than obviously credit cards.
Yeah, so while they are different, they do kind of give you that one-time signing bonus. You do sometimes get a 10% discount on your purchase. So it is great to kind of look for that. But of course, you don't want to just continue to kind of sign up for all these loyalty programs. Your wallet tends to get quite full. And depending whether it's a credit card or just a loyalty program, you want to be conscious of how many hits to your credit score you're having.
Yeah, I was just about to say that, right? We're not suggesting that everyone runs out and buys and signs up for a bunch of credit cards because it's a hard hit to your credit score. You're managing a lot of different credit cards, and if you don't watch it and you're keeping a balance, then it negates the purpose of this, doesn't it?
Absolutely.
Yeah. Natasha, so much insight here. Thank you so much for sharing your advice. We really appreciate it.
Thank you so much for having me.
Thanks for coming on. Well, stay with us because when we come back, we're going to talk about a proposal that could save you money if you want a financial plan done. So we'll talk about that when we come back. Welcome back to Strictly Money. If you've wanted a financial plan done, but the cost of getting one has put you off, you might be in for some relief. FP Canada is lobbying the federal government to introduce a tax credit to encourage low and middle income Canadians to get financial planning advice. To talk about the proposal and the role financial plans play to improve the financial resilience of Canadians is Sebastien Labrecque. He is Chief Economist with StrategyCorp Institute of Public Policy and Economy. Thanks for coming on, Sebastien.
Thank you so much for having me.
So this is FP Canada that wants the federal government to introduce this tax credit to support lower income Canadians to get financial planning advice. And I know you were involved. You've created this white paper. Why are they doing this? What's instigated it?
So I think really when you think about what happened during COVID, it really is the genesis of all of this, right? Financial resilience. Canadians have struggled with financial resilience well before the pandemic, but it's really the pandemic that shed light into the situation. And coming out of COVID, now we have inflation and economic uncertainty. So the financial resilience of Canadians continues to be challenged. So that's kind of what we look at in the report in terms of what is the state of financial resilience. And we'll get into that a bit later. And also, how can we help Canadians, especially as you mentioned, low and middle income Canadians, improve it? And we find that there's evidence that financial planning would be one of the solutions.
Yeah, let's talk about financial resilience because I'm sure a lot of our viewers have not heard of that term. What is financial resilience and what is the state of it? How has it changed?
So I like to answer that question by saying what it is not.
Okay.
I think a lot of people think, financial resilience is about having a big job with a big salary, or, it's about having a lot of money in your bank account. And, that's not true at all. When you look at the definition of financial resilience, if I tell you that it actually varies. There are a lot of definitions out there in the scientific and government literature, but they really have two things in common. It's multidimensional, and those dimensions are actually interrelated. So for the context of the paper, we actually use the definition of the Financial Resilience Institute. And I will just read it to make sure that I get it right. It's a household's ability to get through financial hardship, stressor, and shocks as a result of unplanned life events. Now, one thing that I want to stress here, we often think of unplanned life events as, losing your job or something negative. But when you look at the literature more broadly, life events can also be positive and have an impact on financial resilience. Think about, you're having twins instead of just a child, right? All of a sudden, you're paying more money for a variety of baby products. So that can also stress your finances. So that's really the definition we're working with. And from this definition, there's an index that was created by the Financial Resilience Institute. And to answer your question specifically about the state of play, the number of Canadians that are financially resilient is actually decreasing. It's now at 22% as of June of 2022. It used to be 31% just a year ago. If you look at the other end of the spectrum, and you have it on the screen here, so this is great.
Yeah.
So if you look at the other end of the spectrum, 21% of the population is extremely vulnerable. And if you throw in there people that are financially vulnerable, which is just the category above, you're actually looking at half the population. And on average, women are more likely to be less financially resilient than men. So it's a significant issue across the population.
Yeah, and I gather it's gotten worse with COVID and the pandemic.
Yeah, absolutely. As the numbers you had on your on the screen, the number of people at the one end, that were financially resilient down, 9%, and then at the other end of the spectrum, the number of people that are extremely, you know, vulnerable also grew.
Sebastian, we only have 30 seconds to the commercial break. Where are people most vulnerable?
I think we're going to need more than 30 seconds to cover this question, but perhaps I can give a teaser. Household debt, savings, and retirement savings, but we can talk about this more.
Okay, household debt is a big one. Well, that probably leads to because of inflation.
Yeah, definitely one of the factors.
And what was the other one? Debt.
Savings, lack of savings.
Okay. And then the last one was retirement savings, which is a tough problem to solve, but we will unpack that after the commercial break. We'll be right back. Welcome back. Sebastian, before the break, we were talking about where Canadians are most vulnerable. Savings, not a surprise, although it was interesting because during COVID, there was this big, I think, divide. A lot of people said that they saved a lot more, and then I'm assuming a lot of people didn't.
Yeah, no, exactly. And when you look at aggregate numbers, it's always misleading, right? It looks like, oh, billions of extra savings and bank accounts, but really, when you look at lower income individuals, the ones at the bottom of the income quintiles, it was still they still experienced net negative net savings over the course of the pandemic.
Can we talk a little bit about some of the myths that people have around financial planning? Because I often hear, Sebastian, well, it's about investing, and it's not, right? Especially because there's this rising challenge of outliving savings in retirement, and financial planning does play a big role in that, doesn't it?
No, it definitely does. And I think it just speaks to the nature of financial planning. It is not, and that's what makes this profession different than other financial professions, is that it looks at a wide array of aspects. Sure, it will look at investments, but it will also look at your financial management. We'll look at your insurance situation, your tax situation, your estate situation. And all of those, as I mentioned at the top of the show, they're all very much intertwined, right? If you don't have good insurance, you might be actually putting at risk your cash flows now, but also in the future. Insurance plays a huge role in estate planning. Think life insurance, for instance, right? So that's really why financial planning matters, is this ability to look at the multiple dimensions and how they interface with one another. And the literature does show that working with a financial planner has a positive impact on various aspects.
What would you say for those who are in, say, low income brackets that say, well, that's not what I need?
So I think it's definitely, it's easy to fall into this trap that, well, if I don't have money, why should I work with a financial planner? I don't have money to invest. But I think it just goes back to what you and I just mentioned, right? That it goes well beyond investments. So, you might be, a low income household, but you still need to account for things like, estate planning. At the end of the day, everyone dies. Tax still matters, and as well as your insurance. And some point, hopefully, you get to retire.
Sebastian, I'm a huge advocate for financial planning as someone who did it, and I know how important it is, which is why I would welcome this news about this tax credit. Can you tell us a little bit more about that, what the proposal is, and just how it would work?
Yeah, most definitely. So the inspiration behind that credit is the Canada Training Credit. So if you remember, that was introduced by the government to incentivize more Canadians to seek training and improve and upskill. So in terms of the proposal we have in the paper, we recommend that it be introduced on a pilot basis at first to allow for modifications and see how it plays out. And it would be only available for individuals that are seeking financial planning for the first time. Because really the goal of the credit is to incentivize more Canadians to seek financial planning. It would be refundable to make sure that it actually brings the certainty of a return, notwithstanding your income. And also, it just learns, quite frankly, the lessons of the US, where they had an itemized deduction. And as you can imagine, it mostly just benefited people with high income.
Right. So that's why
Um,
the tax credit and not a deduction.
Exactly.
Okay.
And perhaps the last thing that is really important to mention would have to cover multiple areas of financial planning, because as we said, it's not about only focusing on investment. And as you probably figured out by now, the focus is really on low and middle income individuals. So it wouldn't be available to people in the higher brackets.
That was my next question, is what the criteria would have been, right? Because you want a proper financial plan done. We only have 20 seconds, Sebastien. Any indication of the timing of this and when we could see it come to fruition?
The next opportunity for the government to introduce a measure like this, obviously, is the federal budget. I think, last year the government told us in the last budget that they were seeking to improve the resiliency of the economy. But I would argue that you can't have a resilient economy without resilient households. So there's a
100%.
bit of a perfect alignment here.
Yeah. Sebastien, thanks so much for coming on today. We really appreciate it.
Thank you so much.
Well, that wraps up this edition of Strictly Money. Thanks for watching. We'll see you next time.